Okay, good evening, everyone. Okay, good evening, everyone. Like I said, good evening. This is Dr. Kristen Ray. She'll be joining us this evening to chat about her recent apartment complex deal. Dr. Ray, I'm really excited that you're here with us. Thank you for joining us.
Thank you for having me.
Can you tell us a little bit about yourself and how you got started in real estate, why you chose to do multifamily, just your whole, well, actually, you know what, let's start with the basic introduction. What do you do? Who are you? What do you do? Why are we here today?
Okay. Well, my name is Kristen Ray. I'm a buy and hold real estate investor. I'm from Maryland. I've been in real estate since 2011. I started out in real estate. I inherited some rental properties from my great-grandfather who passed away. He passed them down to my mom, who in turn didn't want to be bothered with them because they had tenants in them, and she didn't want any bother. So she in turn passed them down to me, my brother and I. And for all you ladies out there, at the time that I received this inheritance, of course, I was grieving the loss of my great-grandfather who had a profound impact on my life. But I was breastfeeding a 6-month-old baby, and I was in school for my master's. I was working night shift at a hospital, going to school all day. So I was essentially partially insane. So, and then someone says, "Oh, here's some rental properties." Like, I don't understand what you're talking about. So my first thought was to sell them because I didn't want to be bothered either. You could imagine I'm sleep deprived, I'm working night shift, I have a 6-month-old baby. I couldn't imagine another responsibility. So we were going to sell them, but at that particular time, the market, at least in this area, was not, well, it just wasn't a good time to sell. The numbers didn't make sense. So because the properties did have some debt on them. So we decided to keep them. I didn't know what in the world I was doing, and neither did my brother. But luckily, we had good tenants there, and they're still there today.
Oh, wow.
The same tenants are still there. So they've been very good to us. So we decided to keep them. So fast forward, I finished up my master's, and I went back for my terminal degree, and I didn't want to take out any student loan debt. I mean, I don't think anyone really wants to. So I was, trying to figure out how I was going to pay for it. And I decided to do a cash out refinance on those rental properties and pay for my terminal degree. So once I did that, I realized everything that I thought I knew about money was wrong. I said, okay, I need to focus more on investing and leveraging some of these assets versus, more consumer debt, more student loans, more debt that does not essentially produce another form of income necessarily, and certainly not any passive form of income. So I leveraged those, and my tenants paid for my terminal degree. So when I was finished school, I decided to just go all in on real estate and get a lot more aggressive and said, well, if I could do that, well, what other strategies or what other income streams could I build? So that's what I'm pretty much doing ever since.
That's awesome. That's awesome. So you pretty much jumped into real estate, reaping the benefits kind of upfront, like with your cash out refinance that you did, and really seeing hardcore, like real life, what real estate could help you do. That's amazing. So after that initial gift, what was your first, like, on your own deal?
So I picked up a single family. So I did a few turnkey-ish properties. They weren't heavily distressed. And then after that, I did a duplex, and I always call that was my lesson. That was my property from hell. Okay. And that was the turning point in my mindset where I said, you know what? If I'm not going to do something that's more hands, if I'm going to be hands-on, I can't be hands-on like this. That property I know took years off of my life. And I think I have a little bit of PTSD even when I tell the story, because I think about what I went through and I'm like, I cannot believe I survived it. It was horrible. So I thought about all of the time, the effort, the capital, the headache. I mean, the stress I went through, that's a whole nother episode of mistakes, okay? And I said, you know, if I'm gonna put this much time and effort in, I need to get a bigger reward. Because I said, you know, I'm doing all this is just a duplex. I mean, it was like the rehab that just would not stop. So I said, if I'm gonna be doing all this, I should get more of a reward. I mean, it took up so much of me. I mean, piece of me. So I said, well, I always, since I dived into real estate, I wanted to do apartments, but you know, I was just kind of skittish about it. I really didn't know how to, so kind of stayed in a realm where I felt comfortable. But when that realm made me really uncomfortable, I said, well, may as well give it a try. So that's what I did, and I started to pursue larger multifamily deals.
Awesome, awesome. Now, so you went from turnkey to some rehab, and then you had that really horrible one, and then you said, you know what, I'm done with this. I might as well make more bang for my buck. Let's do multifamily. Now, when you first started thinking of multifamily, what kind of mindset hurdles did you have to overcome?
The main, I would say, the biggest hurdle was just not being so afraid of the numbers.
Okay.
Just overcoming any limiting beliefs or any fears that you really put in your own head. Because, you know, once you do something, no matter what it is, you realize, you know, you can do it. And the people that are doing it before you, they're no smarter than you are. It's just maybe they're older than you, so they got to it before you, or their life circumstances led them to that path before you. But it does not mean that they had something or some capability that you do not have. Okay. So just realizing that, you know, it's something that I could do. I was always pretty good at wrapping my head around the numbers. Yeah. And just not being afraid of going from, let's just, for example, 100,000 to $1 million. Just not being afraid of the leap in terms of the numbers.
Numbers, yeah. The added zeros at the end. Like I tell people sometimes that, you know what, it's just extra zeros. It's the same underwriting that you do for a 2-family. Well, technically the same in terms of like the spreadsheet. Like it's the same spreadsheet that I use for a 12 unit I use for a 2-family. Just a matter of the entry points, right? Like just unit 1, unit 2, unit 3, unit 4, just basics, right?
Yeah, I agree. It follows a lot of the same path, you know. I mean, of course, there's some learning curve, but another thing I like about the larger deals, you know, you have partners and you have a whole team to help. When I was drowning with my little 2 units, I didn't have anybody to help me. I had to fire contractors. I mean, it was just a mess, okay? But when you do a syndication or a larger deal, you pull together a whole team. You know, we have 2 attorneys, we have an accountant, multiple contractors. You know, I have a whole team that I work with. So it's not just me out on a ledge. So I made up in my mind that if I'm going to do active real estate, that's going to take a lot of my time and energy. I would rather do a larger deal, but if I'm going to do something smaller, then I don't want something that's a big overhaul, because it can just, I'm telling you, it will suck the life out of you. It will just drain you, I'm telling you.
Yeah, no, anytime you say that, I laugh, because anyone who does rehab has probably had an experience with that property that just keeps going.
Yes, and you just say, please just let it stop.
I talk a lot about rehab as a way to kind of, you know, buy low enough to build an equity from the start, but that's the other side to it. And I like that now you kind of bring a new perspective, you know, saying that, yeah, and we'll get more into into how even how the rehab fits into multifamily now. Now, what was your the first deal you did, in multifamily? Can you talk about how that went, and then we'll talk about your last one, the one that just closed.
Okay, so I had a few intros to multifamily. My very, very, very first intro, I think I own 7% of a small syndication that was done locally.
Okay.
A friend of mine invited me in. So I did some of the underwriting and some of the due diligence. It's 28 units. So that was my first, I call it my baby. The second syndication I did, which is the one that I tend to talk about a little more, it was 119 units. It was in Texas, and that deal did not go very well. So, well, it's one thing when you live and you learn. So, long story short, it was 119 units. It was I believe it was $13.1 million raise.
Okay.
And my partners and I.
Raise. So the full price was what, 60?
The full price was 20.
Oh wow, a big number.
Million, 26-ish, 28-ish. I'm a little fuzzy on the numbers, but somewhere in there.
Yeah.
And so we went under contract and we began our raids, and it was just one thing after another after another. It was a roof issue. And then we used all 3 of our extensions. So long story short, we couldn't close. We ran completely, and then we had to switch lenders. I mean, this was just a mess. So the lender backed out the last minute. We were going to assume the current debt because it had another 2.5 years of interest only. And at the last minute, the lender backed out. We used up all our extensions, and then we just could not get to the $13.1 million raise that we needed. So we ended up losing our EMD. We ended up, yes. So we ended up, our EMD went hard. We lost all of that. And of course, all the attorney fees, all the due diligence, all the flying back and forth to Texas, all of that was gone. And because we had some of our investors whose capital we had tied up from June, July-ish until a little bit before Thanksgiving, we paid them a pref. So even though we didn't make a dime, we lost all kinds of money. We still paid our investors a pref because we did have their capital tied up. So from the date that we were supposed to close based on our last closing date up until, we just said we're not going to get this. We gave them the pref for that whole time. And we did that to show them that we respect the fact that they entrusted us and that we wanted to, stay in their good graces. Yeah. So
just to kind of explain what a pref is to those who are listening. So when people pull funds from others, there are different ways you can give them back their returns. They can either be equity partners or lenders like debt partners, but somewhere in between, you can give your partners a preferred return, which is basically saying, before I get paid, you get paid 7% or something like that, and then after that, then you split, right?
Correct. Yeah, it's like pay for performance.
Yeah, basically. Okay, so yeah, so you pay them out a pref, even if the deal did not close. I mean, when I heard that from your other podcast, I was like, listen, if that doesn't mark integrity right there, I don't know what else. I don't know what else does. And that was why I said, you know what, you have to come talk with our doctors this evening, because I felt it's not often that you'll find somebody willing to actually take a loss on her end to make sure that her investors are happy, right? Anyway, just wanted to highlight that little fact there. Okay, sorry, keep going.
Oh, thank you. But I felt it was really important to do that because the way I see it is all of our investors are people that we've cultivated relationships with over the years. And I was on a call earlier today and I said, I don't have Paris Hilton in my Rolodex. So I guess to say that is all of my investors are people that work, for everything that we have. All of my investors are very educated, most are from the medical field or IT field. So they're hardworking people, just like I am. I don't have, I don't have Kim Kardashian's number. So these are people that go out here every day, roll up their sleeves and work. So I told someone I would lose a kidney before I lose someone's money, because people work hard for it. And you have one time to break somebody's trust with something like that, and you're done. Yeah. So I hold that in very high regard.
Yeah. So after that, you then found this other one, right? The subject property. Let's talk a little more about it. So how did you find it? Where did you find it? How did that whole thing happen? And tell us about the property itself.
So I say the Lord works in mysterious ways. So after going through the trauma of losing that deal and everything that goes along with that, because if anyone knows anything about the real estate process, it can be very lengthy and very cumbersome. So after going through all of that, I would say within a week or two, my partners called me up and they said, hey, it's a broker that we mutually know, called him and said that he has a deal for us in Columbia, South Carolina. And we were the first people that he showed it to, so it had not been marketed. So I said, okay, let's do it. So we went down and we saw it and we absolutely loved it. It's 146 units. It's in Columbia, South Carolina, not too far from the Air Force Base. So we went down, we saw the boat. We did some partial due diligence before we went down, checked out the area, looked at the demographics, looked at the numbers. And the seller was very nice. Him and his wife, they were a dream to work with. They were an older couple who was looking to sell. They were just retiring. Okay. They didn't do a great job at managing the operational aspect, which was one of the ways that we could add a lot of value and increase the overall value of the property by making it a lot more efficient. So rents were very much below market, over $200 a month per unit below market. And it just wasn't being ran very efficiently. The property manager was a property manager who normally does single family, so they weren't using any economies of scale. It was just, it was very much ran like a mom and pop shop. They just kept the rents low because they didn't want to deal with the vacancies and just wrote it out. So we went down there, we saw it, we liked what we saw, the numbers looked good. So we proceeded with putting an offer. It was accepted, and that's pretty much how we got the ball rolling.
Nice. So 146 units, did it require any major rehab work in terms of value add, or was it value add mostly just from the operations?
No, it required some rehab as well, some value add. So we're doing a $5.1 million rehab, starting with the exterior. We've already begun some of that. Okay. And just bringing things up to date. We're also gonna slowly turn the tenants once we kind of clear up with the whole COVID. Of course, then COVID threw a wrench in it.
Yeah. Then COVID.
I know. And everyone here who's in healthcare, I know you're so sick of hearing about COVID by now. I'm not going to belabor that. But that kind of threw a wrench in our plan. So it slowed us down a little bit, but it hasn't been too bad. Our collections have been strong. We were nervous about that when they said, oh, you can't evict people. But our collections have been very strong. What we realized is, and I'm almost thinking maybe it's something in that market, because I don't see this everywhere, but rather than not pay their rent, some people just left the property. The property manager went and checked on the units who were late for May and June. What's this? July, May and June, and they just left. So it was about 13 people, but I would much rather have a full vacancy than an economic vacancy. Someone sitting in there not paying rent. They just left, and it was only 2 people who we kind of put on the payment plan, and they're current.
There you go. I love it.
It worked out well.
Nice. Now we'll kind of take it apart a little bit. Now, the first thing I wanted to ask was, how did you go from, okay, I see this house, this complex, and it looks like a good deal, to, okay, this is definitely a deal that is worth my time and my investors' money. What was the process in between? In other words, what was your due diligence process, if you may?
Oh, so the due diligence process is kind of lengthy, but I'm going to try to abbreviate it for you. The first thing we look at is the market. We look at the demographics. Where is it located? Or is it in a good job market? Because people can't work, they can't pay their rent. So that area has a very good job market, a lot of healthcare down there, manufacturing, schools, military, university. So it's in a good, thriving area. The area has good rent growth year over year. We looked at population growth and our target population. We looked at, in terms of distance, how far it was from some of the major employers. So we look at all those things first. Of course, we look at crime and just desirability of the overall area. So once it kind of passed all of those check marks, and of course we look at unemployment. I mean, I don't want to belabor it, but it's a long list of criteria that we look at before we even bother to go out to the property. So we check all those boxes. And if that looks good, then we'll go out to the property and take a look at it. That's usually a 2 to 3 day ordeal. Usually day one, we get there and kind of get settled. We do a walk around. And either on day one or day two, we'll have our contractors and our inspectors and everything come out with us to do the due diligence. So it's a whole team approach. We do lease audits. We have our contractors in, our surveyors. We get the whole team down there so that we can get all of our third-party reports together to basically verify our underwriting. So we do a preliminary underwriting, but they pretty much solidify it once we get there. Now that could be a point where the deal doesn't work anymore. You know, if you get there and it's supposed to be one thing and it's something else, or you can't get into units, or you feel like somebody's hiding something. I've gotten places where I've done due diligence on other properties, and when we did the lease audits, things didn't add up. So yeah, that's why a lot of times I end up doing things with the third-party companies on day two. And a lot of times I'll do my lease audit on day one and kind of look at it for myself before I drag other people out. But it just kind of depends on the dynamic of the deal and how things are going. So we do all of that, and you know, we come back, we meet as a team, we underwrite again, we look at, you know, get all the data together, look at everything, solidify our underwriting. Meanwhile, in the background, the attorneys are processing the contracts and things like that. We're in negotiation because undoubtedly you're going to probably uncover something in due diligence that you didn't know about. So there may be some negotiation there, either on price terms or maybe a repair credit or something along those lines. And we're, you know, in contact with the lender, making sure they're on board with everything and just trying to pull everything together, essentially.
So at what point did you make your offer on this one? Prior to taking the contractors down there, or after?
Prior to.
Prior, okay.
We I always make offers before I go, but I'll put in the LOI before I go. But the actual contract of sale, the binding document, that's usually days or weeks after we go, before that's solidified.
Yeah. Yeah.
Because, just to make sure that we can come to terms on all the major points before we add another layer. Because the attorneys, they're going to charge you for their time and their efforts to put all that together. So just being mindful of all those moving parts.
Okay. Good. Good. Okay. And then we said we'll talk about financing. So you have your contract now. When did you start talking with your potential investors, and what did you tell them? What did you do? How did you
So,
say, you know what? Take my money, please.
so throughout the years, I've worked with investors on different levels. So I've done some private lending with other investors, on some other deals. So I had some investors who I previously worked with. So a lot of the people who are my investors knew that I did different things in real estate. And also my husband is also a realtor.
Okay.
So once we got all our numbers, everything together, we started designing our packet to send out to show anyone who may be interested what the projected returns were going to look like in our business plan. This is what we had, this is what we plan to do, this is where we are today, this is our plan to get to the end goal. So we put all that together, we lay out the numbers, the returns, the projected returns, and see who's interested. So we hosted a webinar. People who were in my local area pre-COVID, when I could actually take people to lunch, back when we used to do those things.
Food, eating together across the table from each other.
The good old days.
Good old days, February.
Good old days. We used to do those sort of things. And I mean, that was pretty much how I did it. And educating people. I do a lot of education on real estate. One thing that I noticed, and you and I talked about, is in healthcare, a lot of people in healthcare don't tend to do a lot of things outside of healthcare. And a lot of people in healthcare tend to mix wages with wealth. Okay. You can earn a high wage, but you can earn a high wage and not be building wealth.
Yep.
If you're spending most of what you're earning, you're not actually building, you're maintaining. And to go along with that, just stuffing it in a savings account, you're not getting any return. It's what I call dead money. It's just sitting there losing value. You might get 1% in a savings account. And I read recently that some of the high yield savings accounts have dropped their rates recently. So at best you were getting 2, maybe 3. And now it's 1% or less than that. So your money really is not outpacing inflation.
Yeah, right.
So it's not growing. So it's really all on what you value and what it is you want to do. But I've always felt like, well, I mean, if it's sitting there, it's not earning anything, and it could be, then, let my money work for me so that you can spend some of your time doing other things that you love to do.
Yeah. I mean, once you put it that way, honestly, I feel like it's one thing that I tell people is, you're not begging people for money, right? When you offer them your deal, you're actually giving them a privilege. Because the fact that you spend the time, you go all the way down to South Carolina, down to Texas, to check out all these deals you're considering, and then build in there an opportunity for people to grow wealth with you. I mean, that's huge right there. So rather than see it as, oh my gosh, I'm going to be talking to people and begging them for money, you remember that you're actually offering them an opportunity that they will otherwise not have, particularly with someone that they trust, if it's someone that you already have social capital with, right?
Yeah. I agree. And we're very transparent with everything. So, we send out monthly reports, we do updates, newsletters, my investors, anyone I'm working with know I'm just a text message or a phone call away. If they have any questions, I mean, it's very much an open book.
Yeah.
And I also think too that a lot of times, people put their money in Wall Street in whatever mutual fund or stock, but how much due diligence do they do in those companies? A lot of times they don't. They just put into their 401k and ignore it. But this kind of gives you a lot more control.
Yeah, that's true. Okay, now the last big question that I had was, this is in South Carolina, right? The 146 complex?
Yes, it's Columbia, okay. South Carolina.
And you're based in Maryland.
Mm-hmm.
So how have you been able to manage the long distance investing experience? Because I have a lot of people who are like in New York or Oregon or some expensive place, and you're like, I can't find anything that works right here. What do I do?
You have to build a local team. And my partner had another property in Georgia, and that property management company was gracious enough to work with us on the South Carolina deal and help us to put together a team in South Carolina to manage that as well. And we take turns going down and checking on the progress of everything.
Okay. So a contractor team, who else? Does the property management company handle the rehab, or do you have a separate contractor?
Well, I don't really love the property managers mixing property management with contractors, but that's a lesson for another day on why I don't like to mix those two. But the property manager serves as a little bit of a buffer, but they are two independent companies. Some people let their property managers handle the rehab. I don't like that model personally. But they are two separate companies. The property manager kind of oversees some of those operations, and every week, one of the team and one of us is going down there to check on the progress. Right now, they're just doing the outside.
Okay.
But when they start going on the inside, we'll make a few more trips down just to make sure everything is coming along as scheduled. And the property manager is pretty good about keeping us informed as well.
That's good. Awesome. All right. This has been really great. Before we move on to the Q&A session for the Inner Circle members, can you just tell us, like, I know a lot of people want to do their own deals, but then in some cases you actually can't use your own like IRA funds for your own deals. So if you want to use like retirement account funds to do deals, you have to find someone else. So if someone listening, just for example, wanted to invest with you on an upcoming deal, how do they find you? Where do they look?
Okay. I'm on Facebook. Okay. Also, you can email me at info at Vital, VITAL, like vital signs, Vital Investment Partners with the S.com. You can find me on Facebook under Kristen Ray. You could also shoot me a text and we can set up a call. My phone number is 240-390-6141.
Okay, so I'll make sure I put that in whatever notes go out with this recording. But I'm really glad you could join us, Dr. Ray. All right, let's head on over to the Inner Circle folk and